What's up, everybody? It's your boy, Brandon, back with another edition of the Sunday Scaries Stock Talk podcast. But first, a little warning. This podcast is strictly my opinion and the opinion of the guest. It is not financial advice, and it should be never taken as financial advice. It is strictly the opinion of myself and the guest, and should not be taken as financial advice. Any equities or anything like that is mentioned in this, you should do your own due diligence and not invest strictly based off our opinions, as it is not financial advice. And now let's get into the show. Whoosh. What's up, everybody? I am back with another edition of the Sunday Scary Stock Talk podcast. But before we get started, I'd like to thank my sponsor, Inverse. Inverse is a social and collaborative investment research platform. Companies like Robinhood increase access to financial markets. Well, Inverse is increasing access to high-quality investment research and discussion. Their entire platform is built around some top-notch data and tools and on over 10,000 stocks and ETFs, which is seamlessly embedded into the platform. And in the coming weeks, here's a special hint from your boys here at Green Candle. You'll be able to link your brokerage account and share your portfolio to maximize that credibility. So, if you write a thesis on a stock, you'll be able to show, hey, I actually own it. I got some skin in the game. So maybe, you should look at a bull and not listen to all these bears about this certain stock or equity. And you can share your portfolio and, kind of critique it and get some other opinions on it and other great stuff. You'll be able to clean your portfolio with your analytics tool. And I myself has been using the Inverse tool and website for the past couple weeks now, and I'm loving it. So if you want to come and join me on that platform, you could even join my Green Candle group. So come on and join. It's completely free. Now, into the episode, I have a great guest. It's the stock metal investor. Stock, how you doing today?
Hey, I'm doing well. Hope you're doing well too.
Yeah, I'm doing great. So why don't we all go ahead and get into it? So tell me about yourself, a little bit about your background and, how you got into investing.
Yeah, definitely. So first off, I'm based in Germany. So most people on social media, especially in the stock market scene, are from America. And I also don't have the same kind of background that some people have. Like when I hear these the big guys in social media talk about their 20 years in investment banking and stuff like that. I don't have that kind of stuff. I'm 23 years old and I'm just finishing my bachelor's right now, trying to get a foothold in investing. And I've been doing that for the last, I think at this point, a little over 2 years in the stock market and a little bit in crypto. Before that, I had some touching points with investing before. That was in a very different setting, though. That was in a video game where I collected and traded items, which actually was a pretty good time. So that got me my starting capital, and then I think shortly after the market crash in 2020, I started to look into the market and started to buy my first stocks. I switched my strategy a lot since then, and I don't think I own any of the first 10 stocks I bought. So so there is that.
I gotcha. So, how did you kind of find investing? I know you said you're, in college right now and you're just kind of, figuring things out. And generally speaking, people in college don't have too much money or anything like that to throw around. So what kind of made you find investing? And, yeah, was it, maybe your parents or something you learned in school? Or was it just kind of your own desire to grow your own wealth?
Yeah, it basically was my own desire. And like I said, I did the whole trading and investing thing in a video game in Counter-Strike. So that got me somewhat in the mindset, at least of like how it feels to make money and how to see stuff appreciate in value. In school and even in university, I didn't really learn anything about investing. I had a single course about investing, which I got into like roughly half a year after I started investing. So that actually also got me, funnily enough, into the stock market because a friend of mine who was one semester above me had the same course and started investing himself by himself simultaneously as he did the course. So we started to talk about investing, and that's how I got into it. But really, from my personal environment, besides that, I hadn't really had any touching points to investing. The German culture for investing and generally like the whole monetary culture is pretty bad, to be honest. Like in America, you have things like 401ks and Roth IRAs and all that kind of stuff. So you get people, even if it's just through their work, to invest into the market. In Germany, that's pretty much not a thing. I think in America, it's like 50% of people are invested in the market in some way. In Germany, that's like, I think before the pandemic it was 6%. Now it's like 8% or something like that. So it's pretty much non-existent. So if you mention like I'm investing in the stock market, most people around here will say like, yeah, be careful, dude, don't lose all your money. It's a scary place. So that's the general mindset. We had some pretty bad things happen with the .com crash. One of the biggest German companies, the Deutsche Telekom, went public around there, and I think they even had like television advertisement about their stock, and so people piled into that. And if you look at the chart after the IPO, it's pretty much looking like the Eiffel Tower. So a lot of Germans got burned pretty badly, I think, and yeah, that didn't really get better when the market crashed in 2008 again, and a lot of German automakers, I think, got crushed as well. So yeah, it's just not really a good place for an investment culture here. So yeah, that wasn't really I wasn't really able to talk with many people about it.
Yeah, but that's awesome that it seems like you found a friend, or a colleague or what have you that you
Yeah,
can talk about it about with, and it's pretty interesting. I get like a wide range of people from Americans to Europeans and all over for this podcast, and it seems like everyone has kind of like a different perspective just based on their culture. Whereas like you said, it's I think like in America too, it still doesn't have like a great connotation. Like a lot
yeah,
of people still kind of are wary on investing, and I think the stat is like 46% of Americans have some sort of investable assets, whereas I think a good I think of those 40% or 46%, only 15% of those are like kind of like self-managing or have like stocks outside of their
yeah.
401k.
But even those 15% are more than the total population of Germans that invest. So
Yeah, no, for sure. I mean, and
so it's
those
definitely better. Yeah.
Yeah. But obviously the 401k and the IRAs and all these retirement vehicles
Yeah.
are really great, and they help a lot of the Americans get invested.
Yeah, I
Um,
always get so sorry for interrupting you, but I always get so jealous when I see people on Twitter talking about max out your 401k and all that stuff. Well, I can't do that. I have to use my taxable brokerage account. So we get some leeway with a we have 801 euros. I don't know why that's the amount, but we have 801 euros of profit we can make on investments, be it like selling at a profit or getting dividends. So those won't be taxed, but I mean 801 euros, that's not really much. They will increase it to 1k, but still doesn't really move the needle much. So yeah.
yeah, for sure. So, I guess what are like kind of some of the retirement vehicles that you guys have there? Do you have that option, or is it, is this part of the reason why you kind of got started was like, hey, there's not really much retirement options here, so I need to get ahead of this and kind of do it on my own.
Yeah, so there is the German pension, which basically is a state-funded pension, but I mean, if I'm being honest, I expect to see 0 euros or whatever currency we have when I could retire. So I don't really bank on it. At this point, I think we spent like, I think 12% of our GDP just to fund the excess money that's missing out of the pension fund that's not getting funded by taxes. And we already have high taxes, so you can't really lever that up either. So, and it's only growing. And yeah, from the population age, it's not getting better either. So the whole system basically is collapsing. It was invented in 1890, I think, by Bismarck, back when people got like to age 40, and then they had to go through a war or two in between. So it's a great thing then, because you will always have enough young people earning money to help the retired folk. But nowadays it just doesn't work. So I think we do have some insurance thing we can do, but then we are basically forced to put our money in there, and they invest it into a mix of bonds and stocks, which in my opinion just doesn't make a lot of sense. If I invest money now that I will want to have in 40 years, why the hell would I put it into bonds? Like what must happen to the world economy that in 40 years I will have like a better return with bonds than with my stock portfolio? So, and then they always have like at least 1% management fee. So I would rather just put it in, like, even if I wasn't actively investing, I would just put it in an MSCI World or in an S&P 500 index. And it's just a lot better than the options we have in the normal German retirement situation. So sadly, nothing good here.
Yeah, I gotcha. That makes sense. Let's back it up a bit. So obviously started this account to start putting out some investing related content
Yeah.
and things like that. You even write for Seeking Alpha, which is awesome. So how did you kind of get started putting out content? Did what was your kind of overarching goal? Was it more so to help educate some of your friends, like, hey, this isn't as scary as maybe the perception is, or was it just so like you could kind of learn in public and more for, I guess, self satisfaction?
Yeah, it's probably a mixture of all those things and a lot more. I love talking about stuff on Twitter. I have another Twitter account which is just for my CS:GO stuff and my normal real life stuff and all that. So I was already familiar with Twitter and was addicted to it pretty much. So then when I started investing into stocks, I decided that the people over there don't really care about it. So I just made another account at Stock Metal and started publishing there. And yeah, basically it also was to start to learn, because investing has an incredibly steep learning curve. And when you get started, I was very overwhelmed. Like my first investment research, if I can call it like that, is Googling good stocks to buy, which ended me up buying Coca-Cola and Colgate Palmolive. So I mean, yeah, it's a hard place to start. So I decided if I can put out content and get into conversation with others, then it's probably going to be a lot better for both parties. So that's how I got started with Twitter, and then everything else revolved after it.
Yeah, I gotcha. That makes sense. So, like you said, you kind of gotten started educating yourself and doing all that kind of stuff, like whether it was on Twitter or Seeking Alpha or some of these other places. How have you gone about, educating yourself? Did you like kind of read a lot of books? Have you like kind of found, I guess, various resources or something along those lines on the internet, or is there something that else that I'm missing here that helped you kind of along your investing journey?
Yeah, so I didn't really read too many books. I think the first book I read was, like most people, The Intelligent Investor from Graham, which I think I read maybe 4 months into the whole thing. So I don't even think I finished that one. It bought me a lot, to be honest. So I kind of started reading that, but then I stumbled over several chapters only talking about bonds, and I looked at the market and was like, bonds are yielding 0%. yeah, I'm not putting that into my portfolio. Why is he talking about it? So that really didn't resonate with me early on. So I didn't really start with books. I pretty much started with looking on YouTube and looking on Twitter. Twitter was also kind of rough for me to get into at first because I didn't really understand the whole ticker thing. Because in Germany we don't really use those tickers a lot, so we just look up the stock name. And when I then went onto Twitter and I saw all these tickers, which in some cases don't even make sense, I was just super confused. So I found some good German YouTube channels and also some good American YouTube channels later on. So that helped me a lot. And then it was basically between Twitter and YouTube for the beginning.
Gotcha, that makes sense. And yeah, I mean, I tried to read, I think my grandmother gave it to me one year for Christmas because she knew I was like super into investing. She gave me the Intelligent Investor, and I've tried
Yeah,
to get through it, but it's just very technical.
yeah.
And I
It's
think
not it's not a good start, but everybody recommends it as a start, and I just don't agree with it.
Yeah. I think it's like more so like, for me, a big book, and it's really popular kind of like in the real estate investing space where people
Really? Okay.
well, not that book,
Oh,
but
okay.
another
The
book.
one you read.
Yeah,
Yeah.
so
Okay.
another
Yeah.
book
Got it.
that I'm recommending is Rich Dad Poor Dad. And
Yeah, I
that
heard
just
about
says
that. Yeah.
like whether it's investing or just like kind of like a lifestyle thing. I think that book is a good starter to kind of get people in the mindset. It's a little bit more tailored towards real estate because that's how
Hmm?
he is. He talks about cash flow and other things, but it kind of gets you guys, I guess, like in the mindset of like, hey, I'm going to pay myself for something later down the road.
Yeah.
And so I think that one's a little bit easier to understand. It doesn't really get into the nitty gritty, the technicalities, all the mathematics and everything to evaluate stocks and things like that. So yeah, I agree with you. It's tough, especially if you don't really have that background and you're not like super, super into, reading about all this kind of stuff with
Yeah.
stocks valuation. But obviously it's a little bit more of an advanced book. And I think that, it can kind of be good for people, down the road. But initially it is pretty tough to
Yeah,
say.
there are definitely better books, and I also read better books later on, which I wish I would have read earlier. But then again, I mean, I'm 2 years into the journey, so I'm not really too disappointed on it. But
Yeah,
like what I'm reading right now is from Peter Lynch. Uh, oh, what's it called? The really popular one.
I don't know.
uh,
I'm gonna
Let me
look
Google
it up.
it. Yeah,
Most
one step ahead of Wall Street, I think it is called.
Okay. One
But
Up
yeah,
on Wall Street.
One Up on Wall Street, yeah.
There you
So
go.
like that's a really good beginner book, I feel like, because it talks about his approach. I'm not through it yet, but it's basically his approach of buying things that he sees in real life. For example, we miss so many things when we just focus on the numbers, but if we walk outside and see all these stores and see them expand and like selling good products, so that's one approach which more so in the US, to be honest, because most of the time German brands aren't really public. So if you see a rising German like restaurant brand, for example, chances are they are private. So that's also a disadvantage with investing in Germany. But yeah, we basically get the US stuff when it's already big most of the time. So
Yeah, I gotcha. I understand, but I mean that's pretty awesome. I mean, because it's a pretty similar strategy to what Warren Buffett, kind of goes about
yeah,
and teaches as well. So I think that when it comes down to a lot of these big guys are like, hey, you can complicate investing as much as you'd like.
yeah,
You can get into the numbers, you can do all that kind of stuff, but at the end of the day, you could just walk outside or walk down the street and see which brands are thriving, when you go to these stores and other things like that. So, or if you just kind of look around and say, like, hey, all these people have iPhones and MacBooks or
yeah,
whatever.
pretty much.
So, I definitely think it's like, a good way to go about it and everything like that. But, on the content note, how do you kind of determine what is good information and bad? because I think that there's like a lot of mediums that you could put out your content now. You brought up YouTube, you brought up Twitter, and even some of these people with like large followings, they don't really put out great content or
Yeah.
things like that. So how do you kind of determine the good information from the bad?
Yeah, that's a very important part. That also kind of turned me off Twitter at the beginning. You get all these very huge accounts that only talk about like success and all that stuff. Basically, like pay yourself first, get a second income stream as fast as possible, but they don't talk about how to get it. They just do some inspirational stuff that doesn't really get you anywhere. And they basically post that every day, I feel like. So yeah, that's also a problem I have with many dividend accounts, because it's always about like, yeah, I'm getting that yield and I'm reinvesting it. Yeah, that's not really interesting content in my opinion. So there's a lot of content that is not really great. So in my opinion, it takes a while until you can go through it and see what resonates with you. So yeah, it's kind of hard on the spot to say what I look for, but I try to look for people that don't really throw around too many numbers that don't make a lot of sense, and then people that focus on a single thing, on a range of things. So that's probably a way you can do about it. And people that don't pretend to be great at what they do, like I prefer people that show some humility and don't put out how perfectly they bought the dip and all that stuff, because chances are they didn't. So yeah, but then again, every medium is different for that kind of stuff. If you look at YouTube, for example, it's very different for Twitter, but I feel like you just have to go through it a bit and see for yourself. Kind of hard to like get a specific criteria for that, I feel like.
Yeah, for sure. And I think, the way that I do it is I kind of look at, I take the information and I don't immediately go run and buy whatever these people are
Yeah,
saying.
definitely. Yeah.
I think I kind of go and like try to find multiple sources on it. I do my own research, and I definitely like sit back and try to think like, how like does this make sense?
Yeah.
I take it for what it is. It is a person putting out content and trying to, either learn in public, kind of something that maybe you and I are doing, or like, as an expert in the field, and then we can really track the results and see, what they're talking about. And so I don't know, I think, yeah, it is a tough thing to do now, but I think, there's also, somebody that you got to kind of relate to. So whether it's,
Yeah, definitely.
yourself, where it's like a student kind of going through and figuring it out, or if it's like, I think a lot of these experts are really hard to relate to for the average person, because they
Yeah.
get technical. And once you don't understand things and they start kind of talking over your head, I think that's where a lot of these content creators lose a lot of value. In my
Yeah.
opinion, I think I try to always dumb it down to, where a third grader or somebody with very minimal education or has no idea about investing can kind of understand what I'm saying. And I think that's where the true value, lies for a lot of these content creators, is that just the ability to kind of relate it to majority of people or to the masses. So, yeah, I definitely think it's great that there is a lot of content out there, but it is kind of a little bit harder right now to like filter that.
Yeah.
Um,
It's a blessing and a curse.
Exactly. And so you mentioned it before, you're currently in school. You're getting a bachelor's of science in business informatics.
Yeah.
So that isn't, at least I haven't really heard of that in the States. So what is that degree kind of entail? And how do you kind of think that your background in business informatics is going to help you become a better investor?
Yeah, I think it's a pretty popular thing in Germany, but it's not as popular outside of Germany. So basically, it is trying to combine economics and informatics, like the name suggests. So we get thrown into all these different topics like accounting and programming and all that kind of stuff, but we don't really dive too deep into it. But we get I don't want to say surface level, understanding of many different topics, but we aren't really experts in one topic, but rather get to learn a lot of different things, and then we can later on decide where we want to go into. So I first got into the bachelor's the bachelor thinking I would do something with economics, and now I'm doing an internship, or pretty much my bachelor thesis, in programming, so in software development. So kind of funny how these things go. So it's pretty cool that you get to experience a lot of things and try stuff out, because before my studying, I hadn't really had any touching points with programming. So I got to understand that a lot better. And also, we talked a lot about enterprise software and systems like that. So that I feel like also helps to see the relevance in all these systems and kind of understand how they work. And that's also where I see a good match between investing in stocks, especially technology stocks, and my degree, because I know how to program, I know how these systems work. So that gives me an edge if I buy some tech stock, and I can also like see if it could like provide any value, or if it's just some novelty software that, I don't want to be harsh, but that nobody actually needs. So I feel like to figure out a mode, it also helps a bit. And then also the economics part, which didn't really help too much. I mean, I got a basic understanding of things like accounting and how banking works, maybe at a surface level and all that stuff. But at the end of the day, I was in the lecture about investing after half a year of investing myself and absorbing knowledge. And I felt like I had more knowledge than my professor. So, or at least she didn't really do a good job at portraying like the important parts. I had a 6 month or like 5 months lecture on the stock market pretty much, and we didn't really like go into how to value a business besides like a just getting thrown into a discounted cash flow, which didn't really like make a lot of sense if you don't understand the things behind it. So yeah, I feel like the economics part didn't really help me as much as I would have thought, yeah, about investing.
Yeah, I think that that's interesting because at least in the United States, you have to take like a general economics course, no matter what degree you got.
Yeah,
And that's
we had that in my normal school as well, but then again, it didn't really dive too deep.
Yeah, it doesn't get very deep, but we have simple things like supply and demand, and just
Yeah, we had that. Yeah, yeah,
yeah, other kind of metrics and stuff like that now, which, if you kind of take a look and like zoom out on a lot of the economic policies that are going on now, it seems like a lot of these policies are just kind of ignored, which
yeah,
is kind of interesting. And, exactly like you said, I feel like the good investors kind of just break it down and make it very simple. Whereas, now a lot of times that those things get kind of muddied up. People try to, make investing a little bit more complicated than it really is. And I think, investing gets a little bit more simple when you kind of zoom out and have like a longer time horizon. And so, on that note, I know that you kind of look at your description on Seeking Alpha says you look at great capital allocators, spawners, and companies with deep and widening moats. So, what kind of things do you look at when you're looking at companies, and kind of how do you view it? Like, what are your goals when you invest in a company? Do you plan on, do you like reevaluate every year, or every month, or every week, or what? Or do you kind of evaluate it, buy and hold, and granted, as long as nothing drastic change, you plan on holding that for years to come?
yeah. So I try to do a strategy where I hold until basically my retirement in the perfect case, or probably even longer. So I look for companies that have durable growth and that have a durable business model. So that's also where I try to look at what the company does and figure out, is it actually necessary for society? Like, does it help anybody? do they have competitors that do it better? I try to avoid that. So I try to go for market leaders. So that's the surface level on the mode, and then I try to understand better why it is a good mode, why it is deepening or widening. And then also one very important part for me is capital allocation. I I got into that when I read 100 Beggars from Chris Meyer. That really was when that whole idea of capital allocation excellence really started to resonate with me. Because before that, I didn't really get into that. But I think in the book he quoted Charlie Munger talking about uh, even if you buy a company making 6% on returns on capital at a steep discount, it will still be a worse investment than a company generating 18% for a lot of years to come, even if you pay a premium for it. So this whole idea of buying good businesses or excellent businesses at a fair price rather than okay businesses at a great price kind of resonates with me. So can you go back to the question a bit again? Because I think I stumbled around a bit.
Yeah, no, it was great. You're
Yeah,
essentially like looking at companies that you believe are great businesses,
yeah,
and you're not really worried about timing the market or anything like that, as long as you believe that it's going to be a good business long term.
yeah.
So, you kind of spoke on it a little bit about wanting to buy and hold these stocks until you're maybe around retirement age. But what is your overall goal with
Oh yeah,
investing?
exactly.
Yeah.
So my overall goal is, like most people, to get financially independent at the end. So especially with the way German retirement works, I don't really want to have to be forced to rely on it. So I try to get a lot of capital, and then eventually I will probably either change my strategy, or ideally I will have companies that pay a good dividend, because right now I don't focus on it. But I would argue that in 40 years, the kind of businesses that don't pay a dividend right now, but are high quality businesses, will pay a dividend back then, uh, in the future then. So that's sort of my goal, just basically to have basically my own life in my own hands and not rely on somebody else. So yeah, that's my reason for investing.
I gotcha. And so you kind of touched on this a little bit earlier about, the investing culture in Germany, how it's not very rampant or anything like
Yeah.
that. So how is that? Have you felt that that has kind of changed, as of late? I know you said that the percentage of people invested has kind of gone up since, the COVID pandemic. Do you think
Yeah.
that it's trending in the right direction where more people are kind of, coming around to it? Or do you still think that there's some big hurdles before some big hurdles to get over before investing culture is kind of where it is now in the United States, in Germany?
Yeah, it is definitely moving in the right direction. We had the same phenomena as in the United States with companies like Robinhood. We don't have Robinhood, but we have other discount brokers that broke down a lot of the barriers. Because before the pandemic, most of the brokerages had atrocious fees. Like you would pay, I think, like a cheap transaction would be like $10 or so. So that's not really something you want to do if you have little capital. And also, it took ages to verify. For one, you had to get a copy of your ID and mail it to the company in our age where everything is digital. So we had new players come into the market, digitalize the whole process, and cut down on fees. So that really helped. And then the whole market euphoria, of course, with the whole helicopter money and all that stuff, really got people into the market. Because, like, statistically, if you're if the market is in a bull run, then people will jump on, and sadly people jump off in the worst time when we crash. And that is also happening in Germany. I think around 300,000 people stopped investing in the last 2 quarters or so, since the market started to dive. So that's I don't know how much that is, but it's probably a good bit of the progress we did. Yeah, but I feel like that's normal. We always have people leaving in the worst possible time.
Yeah, of course. Always in the worst possible time. So,
Yeah.
so you've kind of gotten into it about how your investing process in Germany. You've mentioned a little bit before you're a value investor. How have you kind of come across that strategy, and why did that strategy resonate with you, and you decided to become a value investor?
Yeah, my strategy changed a lot. Early on, like I said, my process wasn't really there. Like I remember Googling good stocks to buy. I bought Coca-Cola and Colgate-Palmolive. Then I watched a video, good Chinese stocks to buy, and I bought Tencent and Alibaba. So there wasn't really any strategy and any thought process behind it besides having a perfectly balanced portfolio with different countries and different industries and all that stuff. And then I ended up with, I think, around 35 companies in my portfolio, plus some ETFs in, I think it was early 2021. So I had a lot of like dividend stocks and all that stuff. And then I got into the whole growth investing niche and traded my dividend stocks, which were kind of cheap, for the growth stocks that were way too expensive. So yeah, then I changed to growth investing and started to build convictions in some companies. I also started to look more into qualitative features. And as I went further, I noticed that some of these growth stocks just don't have the same qualitative aspects that I actually look for. So I started to like go away from growth investing in parts and started to go more into the quality or value investing I am doing now. Value investing is always a very hard term to define, I feel like. So for me, it's pretty much I want to buy durable companies that will continue to compound capital in an effective way. So I guess it's not really traditional value investing, but rather my definition of it. So that's what I look for in companies right now. Like basically having a focus on how management takes the money, the profits of the company, and reinvest it. And if I have a growth stock, roughly looking at how it is reinvested without the other qualities that mature businesses have. I think a good proxy is return on capital and return on equity. But if we look at a company like, for example, Mercado Libre, then they don't really generate net income yet, so you can't really judge that a lot. So there are different ways to look into these companies as well. Then
Yeah, that's crazy. It sounds like, even though you've been investing for 2-ish years, you've
yeah.
gone through quite a few strategies. So what makes you think that, this strategy is gonna be the one? And, how does it I guess, kind of help with your conviction with investing? Because I think when you get a lot of these growth stocks and they're, maybe high value,
Yeah.
or they go through the swings, it's difficult to hold on to some of your holdings when it's riding on these up and down waves. And especially, in a time like now where it's, very inflationary, and we're seeing a dip going on right now. So how do you kind of help yourself find that conviction when it comes to, a certain stock that you're investing in?
Yeah, the book that mostly influenced me there was, as I mentioned before, 100 Beggars. That book really breaks down what you should look for. It's not even about getting 100 bagger, because I mean I'm fine with it if it doubles in a few years or so. Don't really look for that kind of return. But it talks about qualitative aspects that a company should have. So basically, a lot about the capital allocation part, that companies should allocate capital well. And that also got me away from dividend investing, because, in my opinion, there are five or six ways a company can invest money or like use the profits. that is reinvest into the business, which is obviously the best idea if you have a good return you can get on that investment. Then I also like acquisitions, but only if the company is good at acquisitions, because you can destroy a lot of value with acquisitions, like most of them actually do. I think it's like 70% of acquisitions destroy value, I think I read somewhere. So those are two of the good ways I feel like to invest money. Then there's also paying down debt, which is very situational. Then there is buying back shares, which is also very situational. And then if you have money left over, it's paying a dividend. So what I felt like after reading the book is that dividends are really not something to strive for, but rather a byproduct of a company that kind of doesn't have much ways to expand anymore. So that was a major learning why I look for companies with high quality that also often pay a dividend, but not a big one. My highest yield is 3% with Texas Instruments, and after that, I think the second biggest one is ASML with 1.2% or so, and then the majority have 0 point something. So that's something I look into. Then I also try to buy businesses that are founder-led, because especially in times like these, I feel like it's great if you can look at a company and you know that the founder and CEO is in the company. He holds like 10% of the company. He will definitely act differently than a manager that holds like a small percentage of his net worth in the company and probably even gets more on a salary basis than his investment. So that is why the whole idea of high quality companies really is great for basically any market situation, in my opinion. Because with these growth stocks, especially with unprofitable ones, for example, you kind of have to fear for your money at some point. Like if growth stops, then they have to finance at like selling stocks, but not at like a 30 times sales ratio, but at a 3 times sales ratio, and the dilution will kill the stock price pretty much. So basically, the goal for investing, in my opinion, is to be able to sleep well at night, and that's definitely something that I look for in companies as well. So yeah.
That's awesome, but I mean, that's a great way to do it. And so, I think even so now, like with the macro environment, we're not going to get into like the deep ins and outs of the macro. We're recording this on Tuesday, July 12th. I know on the 13th, tomorrow on Wednesday, the CPI numbers in the United States are going to be released. So there's probably going to be like an initial reaction, right? So it
Yep.
always seems like the market will react on these days, but it'll kind of turn back to normal the next day or so after
Yeah.
that. So it's very reactionary, and unless you're like a day trader or something along those lines, I don't think that you really need to kind of go through and worry about that, as long as you're investing in companies that you believe are going to be fine in the long term. Of course, if you're investing in these big growth companies, which I kind of think right now are kind of the ones that are going to get burned, because the Fed's tightening rates, and it's going to be harder for these companies that don't actually make money to obtain easy capital
Yeah.
to then, keep that company thriving. So I think, getting back to those value investor fundamentals is really, what's going to be beneficial for a lot of investors going forward. Obviously, not financial advice, not a financial advisor or anything like that.
Yeah.
That's just my opinion on the whole thing. And so, on that note, let's jump into stock investing. So, how do you research a stock? Do you kind of look at maybe a sector that you think is going to do really well, maybe in this recessionary time, or do you look so at more of a broader spectrum of companies, and then you kind of just dive into big companies that you hear about here or there?
Yeah. So my process here also changed in the past. At first, I tried to represent most industries. So I even had some oil stocks and some insurers just to have the sector. But then I really noticed for myself that there is not really a point in doing that, because then I might as well just buy an ETF and be done with it. So I have some industries which I prefer, which is obviously the software industry. I also like healthcare a lot, and I also like e-commerce. E-commerce is kind of tricky though, because e-commerce by itself is not a great business, but most of these companies are great spawners, and they manage to take the cash flows from e-commerce and build great businesses around it. So best example is Amazon. If I could just cut out the whole Amazon e-commerce business, I would do it on the spot and just keep AWS. I mean, it would suck for the advertising business, which pretty much revolves around e-commerce, but the whole thing around it is much more interesting. So that's my take on e-commerce, for example. But so I don't really focus on industries, and that's also a great advantage of the whole quality investing and great capital allocation part. You can really find these in any industry. So what I like to do is I like to not essentially copy trade, but look what other investors with similar strategies do. So that's some great thing you can do on Twitter. You can just look for a high quality company, look who is tweeting about it. Then you can check out some people who are positive about it. Then if you're lucky, they will have some portfolio of themselves on Twitter, maybe even pinned on the top to make it even easier. And then you can go through these companies, do like a very slim dive into it, just look into what it does it look good, scan the numbers. And so I try to look for these high quality companies, or at least what other high quality investors, other investors investing in high quality companies, should rather say, like look at what they have on their watch list, what they get into. And that's kind of my process for these companies in the last time. Going just into a certain industry is not really what I do. So yeah.
Gotcha. That makes sense. And that's that's great stuff. So let's break down then one company that you actually wrote about for Seeking Alpha. And if you
Yeah.
haven't seen that, I will link that article in the show notes below. So you should go ahead and check that out because it's a great article, but it's Salesforce. So how did you find Salesforce, and what is your overall thesis on Salesforce as an investment?
Yeah. I found Salesforce quite a while ago. When I first came across it, it was in a comparison with SAP. Not sure how popular or how known it is in the United States, but pretty much it's the world's largest ERP system maker, so enterprise software. And Salesforce is kind of in a similar way with enterprise software. They do different things, but it's still enterprise software, so the stocks got compared. Back then, I was turned off by the high PE ratio, but then I think a year later, I started to look more into it, and I saw that they had and still have a great and growing market share in CRM, so customer relationship management. They have around 25% of the market share there. And basically, these ERP systems are incredibly sticky. So you have your company and you put a CRM system into it, and then you start to build around it. So if you have the system for, let's say, 2 years, you have to have a really convincing offer from another company to switch from it. So ERP systems and generally enterprise software has incredible switching costs. That's also why I'm invested in Viva Systems, for example, which does a similar thing in the life sciences and healthcare sector. So Salesforce basically is the most dominant player in CRM, and they also continue to build around that themselves. So they have this good ecosystem which keeps growing. They keep acquiring businesses, which can be a little messy sometimes because they take on debt and they buy with stock most of the time. So, for example, the acquisition of Slack they did in 2020, they paid 27 billion, the largest they ever did. Half of it was stock, half of it was debt. So now they kind of are in a mode where they will, stop acquiring businesses for a bit and focus on what they built and try to smooth it out. So over the last year, Salesforce often, or like I think most of the time, traded in a like 200 PE ratio or something like that. So most people will look at it and see the PE ratio and say, no way I'm investing in that. But underlying, you have a business which is growing at 25% at a run rate of 25 plus $billion. So it's just incredible how they still continue to grow their business and all that stuff. They have a very sticky business, and they still are founder-led with a pretty good CEO, I think, in Mark Benioff. So all these different factors led me to invest into Salesforce. And it is a very controversial company, at least on Seeking Alpha. It's one of those battleground stocks where everybody seems to have an opinion. And there are some things I don't really like, which is, for example, the dilution part. Salesforce is a heavy diluter, like pretty much every SaaS company. They have a lot of employees. Their employee count grew at around 30% CAGR for the last year. So they really built a lot of uh, of an employeeship and all that stuff, and that cost a lot. So my thesis on that is that now with the whole building part being done for a bit, they will smoothen it out and improve margins, because it is a software business. They have incredible margins if they can like get the process right. They have gross margins of, I think, close to 80%. So currently net income margin is at like 0% or 1%, something like that. But free cash flow already is at like, I think, 20% or so. You have to look at the dilution as well, of course, because in free cash flow, share dilution isn't really counted as an expense, but it is for a company. So right now margins aren't great, but I believe that when they manage to break down these costs a bit, they spend a lot on marketing, for example, like I think 10 billion a year or so. So all that stuff makes a good investment case, in my opinion, and that's what I laid out in my article. And yeah.
That's awesome stuff. So what would get you to you kind of listed it out a little bit already, but what would be the biggest thing to make you, I guess, sell Salesforce and not continue to invest in it? Because I agree, a lot of these companies, they kind of have that sticky moat where it would need a very enticing offer to switch over from Salesforce to another thing, train up employees, and then you kind of delay business for a couple months. So what would make you change your thesis on Salesforce?
Yeah, I'll definitely look at the margins and if they improve in the future. What really made me happy in the last earnings report was that they actually talked about margins, and that they talked to all the managers in the company and encouraged them to prioritize projects. So that pretty much means that they shouldn't just like do something to grow. They should focus on the return with it more than before. So I feel like that's going to happen. But if, let's say, we look into 2024 and margins still are bad, or if they do more acquisitions that aren't really favorable, so those are some aspects that would really get me to sell. Also, like stock-based compensation should at least moderate a bit, but that again, yeah, it's not one single factor, but the whole story should not deteriorate in that way. Yeah.
I gotcha. This is all awesome stuff. So I really appreciate you breaking it all down and sharing a lot of what you've learned throughout these past couple of years of investing. And now to wrap it up, one last final question. So what is some advice for new investors, and what would you kind of suggest as the first step for them to get started investing?
Yeah, definitely. The first part is don't get discouraged, because when I started investing, it was way too much information, and nowadays there's way too much information coming from all different angles, talking about all kinds of stuff. Don't get overwhelmed if there is too much macro talk, for example, and just try to find a niche you like, or like a investment strategy you like. Try to find people you can talk to. There are great mediums like Twitter or Common Stock, or Seeking Alpha is also good. You can find great communities on Twitter, on YouTube. I mean, Twitter as well. And often these communities also have Discord, so that's also a great way to like actually talk on a more deeper level, I feel like, with people. So the whole social aspect of investing really is what helped me to talk with other people, and also to listen to bearish people. There can be good bears and bad bears, of course. Same way as with bulls. There are also people who bring up valid points, and then again there are people who bring up rubbish. So that's also like kind of hard to do, but be open minded and don't like try to be in the whole like honeymoon phase with a stock where everything is great. Try to be objective, even though it's hard, and try to constantly learn and evolve your process, and try to figure out what works for you.
Yeah, I agree. I think, on that note, finding out what worked for you and getting conviction in those investments is the biggest thing during this
Yeah.
time, especially when it's jumping up and down. It's all great stuff. So, Stock Metal, thank you so much for your time. Why don't you tell people what you got going on and where they can find you?
Yeah, sure. So the thing I'll talk most on is probably Twitter. So that's at Stonk Metal. I am called Stock Metal Investment on most other platforms as well. So on Common Stock, let me see. I think it's also Stock Metal, Stonk Metal. Yeah, so on Common Stock, it's also Stonk Metal. I talk there kind of in a similar way than on Twitter, I feel like. I also have a Seeking Alpha, which I think it's also. Oh no, that's Stock Metal Investment there. They actually got me to rename myself because Stonk Metal wasn't professional enough, funny enough. So that's also where the Stock Metal Investment name came from. So those are the three main ways you can find my content and talk to me. I also have my DMs open, so if you have questions and all that stuff, always happy to talk.
Awesome stuff. Well, everybody should go check him out, and I will include all that stuff in the show notes so you can find those links below or in the show notes if you're listening on audio. So, Stock Metal, thank you so much. And
Thanks for having me.
yeah, have a great rest of your week.